Withdrawing 50,000 a month from a 50 lakh portfolio can either last 40 years or it can run out in just 12 years. And the crazy part, it depends entirely when the market falls. Investors generally think a 12% average market return can bail them out, but there is a suspense. It is not the average return that decides whether you will survive, but it is a sequence of receiving those returns. If the market crashes in your first year of withdrawal, your portfolio may never recover. That's the silent financial freedom killer that nobody talks about. So in this video, I'm going to show you 3 brutally real scenarios, and these are inspired by real market history, 2008, 2011, 2020 crash. And to answer the single question, can 50 lakhs really give you 50,000 per month for life? And if not, what is that magic number that you actually need? And to prove it, I have mapped out 3 real market sequences: a crash occurring first, or a boom occurring first, and a 2008-like disaster. The idea is simple. If you are withdrawing 50,000 every month, the order of the market returns can either stretch your money for decades or it can drain out much faster than you think. So let us see what happens when the bad years come first when you start withdrawing, because that's the nightmare scenario. And I've taken actual Nifty returns of 2011 to 13, and then I've assumed 12% annually thereafter. So we will withdraw 50,000 monthly, and here is what happens when the bad year hits first. You begin with 50 lakhs. In the very first year, the market crashes 24%, just like 2011. Overnight, your portfolios shrink to 38 lakhs. Now, you still need 50,000 per month, that is 6 lakhs a year. So you withdraw that for your expenses, leaving roughly 32 lakhs going into year 2. Luckily, markets rebound 28% positive return in year 2, similar to 2012. Your corpus bounces back to around 40 lakhs now. In year 3, you again withdraw 6 lakhs upfront, leaving you with about 35 lakhs to grow. But this time, the market gives a muted 7% return that year, like 2013. That takes the corpus to roughly 37 lakhs by the end of that year. From year 4 onwards, let's assume a steady 12% annual return, which, by the way, is close to the long-term Nifty average. Even with that recovery and steady growth, something shocking is what is happening. By the beginning of year 13, your corpus hits 0. That's right. Your corpus runs out completely the moment you take out your yearly withdrawal. Think about it. 50 lakhs portfolio, 50,000 monthly income, gone in just 13 years, simply because you started your withdrawals during a market crash. Now flip the script. What if the good years come first after you start withdrawing? Year 1, the market delivers a strong 14.9% return like 2020, taking your 50 lakhs to 57.5 lakhs. After your 6 lakh withdrawal, you head into year 2 with 51.5 lakhs. Then comes a positive 24% rally. Your corpus jumps to nearly 64 lakhs. And 6 lakhs is withdrawn for your expenses. You start year 3 with 58 lakhs of corpus. A modest 4% return in year 3 still takes you to about 60 lakhs. And from year 4 onwards, we assume steady 12% annual return. So here is the surprising part. Because you started your withdrawals during a strong market year, your portfolio doesn't just survive, it actually grows over time. In the sequence, 50 lakhs corpus never runs out, meaning you can keep withdrawing every month and your portfolio is unlikely to ever run out, because the 12% annual compounding after withdrawals is large enough to cover the income and keep growing the base. But before we celebrate this, there is a very critical detail you must understand. In this example, I have assumed that the returns come first and the withdrawals happen at the end of the year. Why does this matter? Because if you flip that, that you're taking money out at the start of the year and then you get the returns on a reduced corpus, your numbers can look very different over time. It's a tiny modeling choice, but it can make a surprisingly big difference to how long your money will last. Now, there is a second very important reason why this happens, especially on an Excel sheet. We have assumed a 12% linear growth every year from year 4 onwards. In the real world, in the real markets, returns don't come in a straight line. They are lumpy. So some years are fantastic returns, some years are flat, and some years are painful. This linear assumption smooths out volatility, which actually understates the real risk. So yes, in this model, your corpus grows indefinitely, but in real life, the journey is a bit more bumpier. And these bumps, the sequence of receiving those returns, often decide whether it makes or breaks the SWP plan. And if you think the first scenario was bad, wait till you see what happens in a 2008 level crash right at the start of withdrawal. Nifty fell 51% in a single year. Imagine that happens to your 50 lakh plan then. So for this third scenario, you start with a minus 51%, followed by a massive plus 75% rebound, and then you assume 12% annual returns thereafter. Your money gets wiped out sooner and faster. This is the nightmare version of retirement. When the markets crash right after you stop working, because crash was not only severe, it happened right at the beginning when you started withdrawing. That's why SWP is not about picking the best fund. It is about designing a withdrawal strategy that can survive the real markets. So we have seen three extreme realities here. One where 50 lakh corpus collapses in just 13 years. Another where it sustains income for life. And the third scenario where it gets wiped out the fastest. Same corpus, same withdrawal rates, same average long-term returns. The only thing that changed was the sequence of those returns hitting. This is exactly why financial planners all over the world have spent decades studying one simple question: how much can you safely withdraw each year without running out of money in your life, no matter what happens to the market? This leads to the famous safe withdrawal rate, first popularized by Trinity Study in the US. Researchers studied 75 years of market data. Their big finding: a portfolio with 50 to 75% equity, withdrawing 4% a year, had a 95% chance of lasting 30 years through crashes, recessions, everything. In simple terms, if you had 1 crore withdrawing 4 lakhs per year, that is 33,000 per month, adjusted for inflation, would likely sustain your portfolio for decades. This was based on US data. India's markets are very dynamic. They have higher inflation, different return profiles, but the principle still holds. If you keep your withdrawals rates too high, like 12% or 50,000 a month on a 50 lakh portfolio, you are playing with fire. But if you keep it closer to sustainable range, your odds of never running out dramatically increase. So instead of blindly withdrawing 50,000 per month, which is 12% withdrawal rate on a 50 lakh corpus, a more sustainable plan would be either lower the withdrawal amount to 4% or 2 lakhs per year, or increase your starting corpus to 1.2 crores to 1.5 crores. The success of your SWP plan is not decided by the average return, but by when the bad years hit and how much you're taking out. If you want to go one step further and see how actually 50 lakhs can be invested in a way to create long-term cash flows, I've done a detailed video on 3-bucket investing strategy. In it, I break down how to spread your money, 50 lakhs, across equity, hybrid, low-risk funds so as to build a stable income bucket so that your withdrawals don't really depend on luck or market timing. And the inflation on a larger base will beat the returns that you can generate. So the corpus will ultimately become zero after 23 years. We are assuming a 6% inflation. If you like the content of this video, please consider hitting the like button. Please subscribe to this channel and share it with your friends.